Hi there, Jim Small here. I want to spend a minute to talk to you a little bit about two different types of investments in U.S. real estate. The first, we're going to talk about buying a single family home. And then second, we're going to talk about buying a commercial property, multiple tenants, whether it's commercial, retail, or whether it's apartments. It's going to operate very similarly. So let's take, for example, a simple investment. Let's say you buy a $100,000 house in the U.S. with your own money. Now, pretty straightforward house. You're going to rent it out, get income. Now, in the other case, you're going to put $100,000 in as an investment in a multi-tenant commercial property. Now, that can work one of two ways. You can either do this also as equity. That means you're part owner. Or you can do this as debt, or it's also called a loan. Now, here's the trade-off. In this case, let's say your property were to get damaged by a tenant or become broken somehow. Your investment might actually go down to, let's say, $90,000 of value, presuming this is an equity investment. You're the sole owner, and you bear all the risk, and you gain all the upside. In the case over here, let's say a tenant damages a property. Again, it could be an apartment. And let's just say it's $100,000 for each of these 5 shares. So this is a $500,000 property, and a tenant damages it, or a storm damages it. There's some damage, and you're going to bear a part of that risk. So it goes down also $10,000, but it's $10,000 for all of the property. So if it goes down $10,000 in value, that's spread across 5 people. And so if you take away the $10,000 in damage one way or another, you're left with $490,000 in value of the property. Now, for you, this means that you actually only took a $2,000 loss because you're 1/5. So your actual value still is $98,000. Clearly much less risk than the same damage on a single family home asset that you're the sole owner of. This is one of the many reasons why people will partner or syndicate on deals. They bear the risk together of the downside, and so if anything were to go wrong with the property, it's shared across. Another example that people think of quite often is what happens if some of our property goes empty? There's no tenants. So in this case, the tenants is either 100%, it's either occupied, or it's 0%, it's not occupied. Over here, you've got multiple scenarios. You can be at 100% if it's all 5 spaces are occupied. If 1 is empty, you could be at 80% occupied. It goes down 60 to 40, and then, in really horrible scenarios, you're down to 20% all the way before you get to 0. In all of these cases, you're making money. In this case, there's money here and nothing there. So the risk from buying a single asset where you're the equity investor and there's only one tenant is much, much higher than becoming part of a commercial deal where you're sharing the risk and sharing the upside. The other thing we'll talk about in the next video is how upside is better when you have a larger asset than if you have a smaller single tenant asset.